Welcome back. Another red flag to talk about. Keep yourself 720 credit ready. By understanding this, remember it's driver's ed for credit. Okay. It's very simple. It's actually easier. It's not nearly as scary. Although credit's way scarier because we don't know about it. But once you do, it's not nearly as scary as driving, especially if you're driving to Texas or Florida. No offense to any nice folks down there, but some of them drive a little crazy. Just saying. All right. What is the next one? Credit builder loans. Okay. Is this a new thing? No, we've been doing rent reporting for like 12 years now. And in the last 10 years, there's been a lot of other credit builder services that have come along. One of them is a credit builder loan. You've probably seen a couple of companies out there that market these things pretty aggressively. And there's pitfalls to these things, okay? They have a purpose, but for a very small percentage of people, okay? And I'm talking very small. I'll give you that use case of what it is. But are these things new? No, they're just new to the internet. They've been around for years, decades. Credit unions have been having these things for years for their young members, which is what they're intended for. Is the families of credit unions a lot of times bring their kids into the credit union and get them their first financial relationship. That's how they get started. And because they don't have anything and the kids want to buy a car or something at some point, the credit union had a service called a credit builder loan, which is basically you put in money into a deposit account against a CD. It's basically just making payments into a savings account, basically, but they structure it to look like a loan so they can report it to your credit report to help you build a score. That's great for 18, 19, 20-year-olds that are new. Mom and dad took them in there so that they can get established like that. The downside of this thing is they're term-based, like a year usually, sometimes 2 years. And in credit, everything is about, your score is all about open accounts on your credit report. Closed accounts, when you pay off a car loan, actually your score goes down because you're losing all this payment history and the credit age goes away. Your score can drop 30, 40 points. Well, the same thing with this credit builder loan is that when it's over after a year, this 1 year of positive payments, just close the book. It's gone. Okay. It gets marked as closed. So your score is going to drop at the end of it. Now, if it helps you when you're young to get to a point of, oh, I got established, I got a 650, 680 credit score so they get their first car or whatever, that's a good use case for that, Wendy. And I'm not going to knock it because of that. Because at that same point, they should have gotten their first credit card, which is going to help them with the credit card portion of the test, remember we talk about how you use a credit card. And it's very simple. Why is it no good for the majority of other people, especially people that have sort of damaged credit or they're coming back from some late payments or a couple of recent collections or something? One, because when it shows up on your credit report, it shows up as a brand new account. Okay. A brand new account is no different than opening up a new credit card or a new car loan. It's got 1 month of payment history and then 2 months and then 3. It's like having a baby. You think about it. You now have something young that you've got to raise up, right? Well, when people that already have thicker credit files with it, you go and open, and they'll open. I see people open up 1 or 2 of these things. It actually will drop their credit age in half, because we'll talk about credit age, how that works out later. But it actually deflects what they're trying to do. And the crazy part about it is these companies online, I think they charge kind of predatory fees for these things, and that they actually charge somewhere 16 or 17% interest for you to give them your money every month. And then they put it in their savings account where they are earning interest on it, but you're paying them a 17% fee for the privilege of holding on to your money to put some green check marks on your credit report, which after a year are going to vanish anyhow.
Sounds like a bummer.
I don't know what else to say about the thing. It's just this small portion. And a couple of these companies that have done this, they raised $100 million in Silicon Valley money, and they don't tell the transparency of what the thing actually does. They put it in the fine print, they hide it. If you go read the ratings about some of these companies, it is ugly. They'll show you the good ones from the App Store or whatever, but go Google Trustpilot reviews or one of these other third-party places. Or go look at the CFPB and see how many complaints they got. Do your homework, okay? Or just listen to this episode and you just know not to go there.